Daily highs and lows. The daily highs and lows are one of the most consistent patterns you will see in the foreign exchange market. And we will get into why, but we're going to look at the importance and we're going to look at the failures to hold above daily highs and lows, and also we're going to look at continuation patterns. You don't want to learn from experience that you have not learned from experience. Well, I learned from experience. I lost $5,000. Well, I learned from experience. Well, you don't want to learn from experience that you have not learned from experience by repeating the same mistakes. A couple of points before we move forward. Each day before you begin trading, you will make a note of the previous day's high and low and the range of the previous day. Not only the previous day's highs and lows, but also the intra-week highs and lows will be your most critically important reference points to start off your current trading day, because they will mark distinct turning points, and these are the reference points where the larger institutions and the banks, those are the primary figures in their head when they're doing their intraday trading. The market will most frequently respect these levels and bounce really nicely or reverse altogether at the daily highs and lows. We also see a pattern of behavior where the open of London will flirt with the previous day's high and low, and very often reverse. And this is really a good level to make a trade. And again, we're going to look at how to make a trade when we get into our ideal trade entry section. But most importantly is if the daily highs and lows are also aligned with key levels that are established by your other tools and clearly established levels of support and resistance. Because if you see that price is trading in a range relative to the previous day's high and low, you can certainly trade just that range itself before it breaks out, potentially giving you even more profit if it does break out if you've had a good entry. If the market tests the high and low late in New York, it's usually unlikely to hold, so that is a fairly consistent pattern, typically unlikely to hold in late New York session when liquidity dries up. Unless, of course, it is an event-driven move. We're going to look at numerous examples, still shots, and then, of course, some simulated trading scenarios. Making money trading the daily highs and lows. When you pull up your charts for the new day and you make notes of your daily highs and lows, we are going to look at those as specific areas where the market will bounce. Just some points for you to read and to look over and consider before we move on to our next section with some examples. All right, this is a 60-minute chart, and I will say that a 60-minute chart is the reason I like the 60-minute chart is because it typically will give me a view over the last 5, 6, 7, 8 days, depending on how compressed your chart is. But it'll usually give me a nice view of the current week, and as you'll see in your manuals on the bottom of the page, that this covers, these vertical lines represent the day, each separate day, and it just gives a real nice view of the current trend. So looking at the current trend, if we see here, what I'll do is as price consolidates into the new day, you will make note of the previous day's low and the previous day's high. And these are levels that, again, that the bank traders, these price points are very specific price points in the minds of traders. And often when price moves up towards these previous highs, we have a real hesitance of a commitment of flows, or we see a real hesitant or often a decline in flows as it reaches these points. And not only will you get a bit of a decline in buying pressure here, for example, but you'll also get an increase in selling pressure because a lot of new funds will flow into the market using the previous day's high as its reference point. And we will see this pattern. This is one of the most consistent patterns that we'll see in the market. So here we see a previous day's high. Price comes up, doesn't quite reach it. I'd like to see it come closer, but then it rejects. And here's the previous day's low, and price does not quite get all the way down there either. So it stays narrowly within the range before the previous day. Remember that the market remains within a range 60 to 80% of the time. The market stays within a range. And if you have the ability to find your entry points within that range, either selling at the top end of the range or buying at the bottom end of the range, with room enough to take profit between the two, then you'll do very, very well, particularly if price happens to break out at the time that your position is in play. Now we see price. Interesting characteristic here is we see the market make a lower high, a lower low, comes up and makes a lower high, lower than the previous day's high. Price comes down, and look how price bounces at this previous day's low. Look at the nice bounce before continuing down. Price trades and holds below this previous low. This is important information. Think about it in terms of the flows. The flows bring price all the way down to this low, the previous day's low. Then finally it moves below. Then we see price trading and holding below this level, which typically suggests another leg down. We see a brief spike up to test the previous lows here, the body lows, before moving down. And we establish a low. Price consolidates into the following day. As market action picks up in the following day, we see an erratic spike down below the previous day's low, but it fails to hold. And as we've seen in the past, as price fails to hold below the low, often we'll see a decline in the selling commitment, and flows will start to move on the bullish side or on the buy side. Price comes up and makes an intraday high. The next day we make an attempt to move above and hold above the previous day's high, but it fails. Price falls, flirts with the previous day's low and bounces, continues to come down in what appears to be light trading, and consolidates into the following day. As we consolidate into the following day, price comes down, tests the previous day's low, no follow through, and price responds by rallying. Even look at this. You see, look at the attempt as we move into the next day. This is Asian session, and I want to bring this point forward. This is very important. During Asian session, we typically see a failure of the market in any attempt to move above the previous day's high. The attempt typically fails. I'd say about 70% of the time, 80% of the time, any Asian attempt to make a move above the previous day's high, it will fail. Even on this move, we still saw a market move that was large enough to actually profit from before price reversed. Here we see the market establishing some very distinct highs. It retraces. At the open of the European session the following day, the market makes a run at the highs, touches the highs, accumulates positions, right? Often the banks will bring price up, and what it does is it generates a liquidity of buyers, and it brings buyers into the market. And what they do is they take these buyers and then they will use them to provide liquidity for their selling, because they want to get a price as high up here as possible before they begin to drive price down, right? So they build up liquidity, buying interest. They use the buying interest to get good fills drive price down, and here we see price comes down to previous level of resistance, now becomes support. From all the way down here, okay, we're at 77.20 pound dollar, and here we're at approximately 78.40. So price moves 140 pips. For price to move 140 pips and then move above and hold above this high would be very difficult, because there may not be enough flow into the market to hold those price levels unless there was a significant event that was pushing price distinctly above these levels. And here we can see the struggle of price to remain above, and then once it decides not to, then it starts to move, consolidates into the next day, and then falls. Where does it fall to? Well, it falls to not the previous day's low, but the intra-week low. It falls to the intra-week low and fails to hold, and then we see a bit of a rally. Finally moves below. Price rallies to resistance, which was previously support. And again, here we see price make an intraday high, and look at the efforts to move above that high and the failure to do so. The other thing that we want to look at here is this level right here may be a significant Fibonacci or pivot level in the larger spectrum, and that may be why it's struggling as well. We also want to keep our eye on MACD. For example, here price makes a new high, but MACD is in a divergent state. Price forms an intraday high, retraces, resistance becomes support, rallies, fails to hold above the intraday high, retraces again. In all likelihood, we were ranging in anticipation of an economic report. Then the economic report comes out and pushes us above. A modest retracement before price once again tries moving above this previous day's high and fails. It actually forms a pennant formation here and then fails. A significant move lower, forming a low. Then the following day, I like these because when we get a big move like this and then price makes an attempt to make a new low after the big move and fails, then we often see a real strong unwind of positions that were, you see the positions that were accumulated here? There was an accumulation of short positions here. And as we see a lack of commitment to move further, then the traders, we are typically unwilling to hold on to any accumulated positions during this stage, and therefore we want to unwind them and square our positions to hold on to our profits in the event that price moves all the way back to our entry point and prevents us from holding a portion of our profits in our pocket. Keep in mind that as you are accumulating short positions in this direction, you are also taking profit along the way, so that you don't leave yourself subject to a retracement move that can give back your profits. The market forming a distinct high here, and as you see here, we remain in this range as price continues to make attempts at this high and continues to fail. Let me ask you this question: if you're to sell every time price tests this high, how would you do? How would you make out? If you were to sell it and take profit at least 20 to 30 pips after the move, and then it comes back and sell it again, even if on this attempt it moved through, you would still have more profitable trades than you would losing trades, which is why it's important to understand the defined ranges. And as I mentioned, the market spends the majority of its time in ranges, so you have to become very comfortable with trading within these ranges and trading at the opposite spectrum of the range. So if price is testing the high, you need to be comfortable to trading short as we're going to give you some exercises on what to do with that in a later section. Because if you traded short here, you could have taken a large profit within the range, left a little bit open in the event that it breaks out, and we see here as it broke out, it moved another 160 pips. Similar scenario here where we see the previous day's low, price comes down and makes an attempt at the previous day's low and rejects it. You should be able to take some profit even on this move here before it comes all the way back here and begins to inflict some agony or some discomfort upon you, and in an attempt for you to shake you out of your position. Resistance becomes support, clearly established level of support, price narrowing, doji, and then a rally. Resistance becomes support. Look how price, you see this high here, look how price struggled to get through and hold above. Here's a high, price struggling to move above, and we get a nice little retracement where one could profit from. And then the following day price moves above. And look where it is supported. Again, folks, as entities accumulate positions here and price moves above this high, that is the primary reference point that they want to protect. And because if price begins to move below this level of resistance, now support, then you're starting to give back too much of your profits, and which is why often price will just come and rest at the previous day's reference point. We have a MACD MACD divergence while price comes down and tests this low, and you're going to see when you scroll through your charts after this lesson, you're going to see how consistent this pattern is day after day after day after day, how consistent this pattern is. And this, along with support and resistance, can be one of your most effective tools. And the reason why is because the CTAs and the banks are looking at these levels and using them as a primary, again, a primary reference point in their trading decisions. Look at the bounce that we receive at this day's high right here, 2 days previous high. Real nice bounce before moving upward. A day's low consolidates into the following day. We get a spike below. It holds, it fails to hold and trade below that level and moves up, and look how it struggles to get above the previous day's high. It struggles for hours right into Asian session. Asia doesn't break through as we move into the next section. This one probably happened fairly fast, and again, simply buying the lows can give you a tight stop, and you can even profit even before you get confirmation that this move is going to hold. Resistance becomes support. Price breaks through the trend lines and moves upward. I love these. I just love these. A nice spike high, then a consolidation, waiting on an economic report. The economic report comes out, spikes up to the previous day's high, then fails. I love this because if the economic report struggles to get through on initial reaction, then that means that the bankers and the speculators are really just unwilling, again, to get above that level and is further confirmation of a ensuing down move, as we see here. We don't just get a immediate reaction with a large down move here. We actually see the market digests the information for some time, and then maybe new information comes out. Then we see price start to commit and to drift lower. And at this point, you see these candlesticks. You see how there's multiple candlesticks and how it slowly starts to drift lower and then picks up a bit here. This is usually a result of more of a lack of buying interest than it is in an increase in selling interest. And here we may have had an increase in flows of selling, but the buy side is very weak after an event like this. After the economic report comes out and the market is decisively against making new gains on the previous day. Not to mention it's the figure. Very nice pattern. We see a rejection of the low here, followed by a nice price move up above the intra-week highs. Price consolidates above the intra-week highs, and we make there's a failed attempt at the new highs here, but even a more distinct failed attempt here with a very nice tweezer top at these highs. And once the first one failed, if you sat and you waited and you continued to watch price and this one comes and looks weak and fails again, this is where you want to make the trade as close to this level as possible. You want to make your trade right in there for a short, because even if it decides to stay in the range, you've got 80 pips, you've got 60 to 80 pips to work with on your trade. And then if it does break out and you have a small portion of your position left, then it's bonus. Again, respecting the previous day's highs and the previous day's lows before the move. This is an example where price fails to move above the previous day's high, but there's still enough room intraday to make profit. Here we have some pivot points combined with our daily highs and daily lows. This is R2, and we have R1 and the previous day's high, and then a down price move. You see how price fails to move lower, rallies, and then falls. This is our midpoint, previous day's low, midpoint, and then a rally. Even though we're in this sloppy market trading environment, it still makes sense when we put it in relation to the previous day's high or low. Look at here. We have a high, which is an intra-week high, and the following day we have a real nice hammer and a failure to hold, and followed by another leg of the down move. Putting this in perspective here, this whole price swing right here from this low, from this high down to this low and retracement, this is approximately it's about a 50 to 62% retracement before we start our leg down. So that's what we're going to be looking for. But also note that you see this support right here. It is a distinct level of resistance for 1, 2, 3 triple top, hammer, and then a move down. And this is how we want to combine all the factors. We're also in the sell zone on the pivots, and we would also have our Fibonacci levels pulled in this scenario. Failure to move below the lows, a move up. Look at where we stall. We stall at the level of resistance. Price falls, resistance becomes support. It's the central pivot. Then we move up. It moves through resistance, support, and we continue our leg up in a nice rhythmic manner. support is resistance. Once again, just a graphic to show you where we are in relation to pivot points. A daily low, price spikes down, it's event driven spike, fails to hold below the low, and then is released into the hands of the buyers. Once I see a failure to hold below, I like to try and find a buy anywhere down in this area that I can. The closer to the low, the better. What I like about this one is it occurs during London and late Asia. So early European and late Asian time. The early bird gets the worm, but it's the second mouse that gets the cheese. Considerations when attempting to make money trading the daily highs and lows. When you open your charts for a new day of trading, make note of the previous day's highs and lows, and also make note of the intraday and intraday and intraweek highs and lows. When the session begins, watch for the flows and watch for early European session to move price towards the previous day's highs and lows to create a liquidity to move price in the opposite direction. Are the previous day's highs and lows, are they a key level that's defined by support, resistance, pivots, fibs, trend lines, candlestick formations, indicators, and other factors? Is there something distinctive about where price is at right now in relation to the previous day's highs and lows, or intra-week highs and lows? You can trade right into the intraday highs and lows, or you can wait for a confirmation to determine whether or not this level could hold. And only experience really is going to help you to discern whether or not an attempt at a trade is viable, because there will be just a huge range of scenarios that will be unfolding depending on economic reports. What's going on that week, what is the overall market sentiment, and what's price doing in relation to where we are relative to the day's highs and lows. And I will take all things into consideration to determine whether or not I actually want to make a trade there, not just simply a one visual technical parameter and make a trade on that one visual technical parameter. So kindly refrain from doing that and use discernment and discretion, and simply increase your understanding of the market to help you to make these potentially very, very, very profitable decisions, and consistently profitable decisions when trading this type of using this type of method for your trading.